Welcome back to Newswire here on SportsGrid. Always great to catch up with Matthew Waters from Legal Sports Report. We're going to dive into a number of topics here, so stick with us. Rush Street Interactive, one topic we'll cover. We'll also talk about earnings reports. They're coming out for various sports betting operators, so we will go over that as well. Matt, thanks for coming on. Let's start off with BetMGM as they jockey for that third spot, second spot, first spot in sports betting. Their new ideas, or maybe old ideas, becoming new again for acquiring new customers. Thanks again. Good to have you here.
Yeah, thanks for having me, Craig. You know that my favorite time of year is earnings season, when we get to, kind of pull the curtain back and see what these companies are doing. And BetMGM is kind of a difficult one to get a read on sometimes. Remember, they're owned by two separate publicly traded companies, and neither of those companies have reported their public numbers yet. So BetMGM, in a release yesterday, couldn't really say a whole lot, but what it did say was interesting. It said that it grew active iGaming customers 18% in the second quarter. It's notable because there was nothing to stimulate that growth, right? It was just the second quarter. There were no new states that came online, and that was up from 9% growth in the first quarter. And so that is leading MGM to say, we think we have something going here with these iGaming customers. We're going to spend more than we thought we were going to acquire them. Now, if you remember, Entain and MGM, the two owners, they agreed that they would need to invest a little bit more in BetMGM this year. Entain had an interim CEO that admitted after the previous CEO was gone that they didn't do the best job at getting American-focused products to BetMGM in those early days when grabbing customer share was so important. And so they're looking at that now, but interestingly, it said that the additional investment in customer acquisition was going to be funded by debt. And that isn't necessarily something I saw coming. I don't know if anybody saw that coming. Neither company has said how much they've invested in BetMGM this year yet. But to bring on debt is a little bit out of left wing, right? Now we can look at that and say maybe they're preparing to spin BetMGM off into its own company. BetMGM is getting close to profitability, and these digital companies have done pretty well when they've had an IPO. So that could be something that they're doing. And you start to play with the balance sheet when you're thinking about that too. Having some debt is better than having no debt in situations. And so it could be one of those reasons. Either way, though, we know that BetMGM is definitely taking the iGaming race seriously in the U.S., and we know that they want to fight to be top in the U.S. They were at one point. We just found out today, Craig, a new report from Eilers & Krejcik that DraftKings took the number one iGaming spot in the second quarter. So BetMGM is still fighting from behind, but they're confident in what they're doing.
Yeah, no, and look, I think that all of these reports, when they come in, the great opportunity not only is to see the revenue, but also, as you say, to be on these calls and to hear some of their ideas. Speaking of which, Caesars, another company that's kind of in that mix with BetMGM and some of the others after FanDuel and DraftKings, a new structural hold target that, certainly will definitely be intriguing to see what they say their earnings are. They changed things around a little bit, Matt. So tell us what happened there. Let's circle back, and then why this report will be interesting.
Yeah, it's interesting. They did raise how much was expected from their structural hold. They're now looking at 8.5%. They didn't hit that in the second quarter, but that's okay. We did see growth coming from Caesars in the second quarter, and not necessarily from the revenue line. In fact, revenue was flat when it came to sports betting, but they held 7.2% across the board, and that's up from 6.4% last year. And that was mostly attributed to an increase in how many bets are turning into parlay bets and same game parlays and all of that we've spoken about, Craig, that we know that these companies are pushing users toward those higher margin bets. And that's helping them survive in these slow periods and the periods where they really get walloped by some bad results. And so Caesars is feeling confident in what it's doing there too. And they are also doing very well in iGaming as well, Craig. They saw their iGaming revenue jump, I believe it was 33%. They're bringing in more customers. They're launching a new brand. They are branding their new iGaming app after the Horseshoe brand of casinos. That'll be live alongside their Caesars Palace brand online gaming app. So there's a lot going on for Caesars right now. They did say that they are not interested at all in any of the Penn Entertainment talks. Remember, Penn is potentially up for sale with a couple of companies maybe interested. We haven't heard anything, too concrete on that. But Caesars is confident that they're going to hit this $500 million adjusted EBITDA rate for the digital segment, and they're going to start seeing that next year. It's going to hit that run rate, which means it'll eventually hit a rate where it would be making 500 million annualized. And CEO Tom Reeg understands that the analysts aren't exactly calling for that right now. The consensus numbers don't show that that's what's expected from the market. But he said, you'll eventually believe. You will eventually believe our iGaming is growing well, our sports betting is growing well, and you will eventually believe when you see that we hit that target. One thing that's helping with them hitting that target, Craig, is they have sponsorship costs that are falling off. Remember, all of these companies went nuts signing sponsorships with sports teams and stadiums and leagues and everything. And they wound up not moving the needle as much as the companies expected that they would.
Gotcha.
And so Caesars has been really happy to see these costs falling off. There was $605 million left to be spent at the end of last year. That's down to about 70 million now. So it's looking pretty good. They're falling that off. They say that's going to fall to the bottom line and help them. So a lot going on for Caesars right now. But frankly, Craig, we're starting to see that, in a BetMGM and a Caesars, that the product on the sports betting side is improving. And we're going to get to the point where those products are going to be close enough to FanDuel and DraftKings that customers may start moving to one of these guys if they have a loyalty account or what have you, or just simply have a strong preference. So it's going to be interesting. This football season is going to be a lot of fun.
Yeah, no, especially if any of these companies jumps into that range of FanDuel and DraftKings. Well, one that's fairly, I think to say, not in that range, but you've covered them pretty extensively, is BetRivers. And they're obviously, even for being a little company, making some very big strides. I know Rush Street Interactive is the company. BetRivers is the parent company of that. And they seem to be, according to, Matt, your story from last week that I read, pretty thrilled with the development that they've had.
They're really happy with how they've been operating, Craig. They report their earnings tonight, and it was interesting. BetRivers is usually pretty conservative. They don't go out and market a whole lot, and so they don't really get too bullish on what they expect from digital and sports betting in specific. But they raised their adjusted EBITDA expectations after the first quarter because they had such a strong quarter, and it'll really be interesting to see if those numbers change again tonight. We know that BetRivers has been performing very well in my home state of Delaware. It's blown out expectations of what the market could do because we had an operator that just wasn't pulling the right levers last time. They're working to keep their costs down. They are growing in Latin America. Their stock finally just hit above $10 for the first time in a long time. So everything is going well for BetRivers right now and Rush Street Interactive. Will that continue after tonight? You certainly hope so for the shareholders there, because it's been close to like $3 at some point, Craig. So BetRivers is churning right now, and I think they are too happy with where they are and going to keep fighting for some spots.
All right. Well, let us know next week about the earnings call there. Matt, I know you'll have a busy day and night ahead of you. Thanks again for coming on Newswire. I appreciate it.
Thanks, sir. Take care.